Hello, welcome to International Finance. This week we'll be covering Chapter 4, Exchange Rate Determination. My name is Dr. George Mochocki. You're taking me on an online class or a face-to-face class, and this is be a supplement to reading the book, uh, uh, lecture within the class, or discussion board if you're on a fully online class, homework assignments. So what you normally do, just a few minutes, you're going to print out my mind maps. You'll have them on the second tier. I created them in a PDF file, so you'll have two sheets, front and back. What you do is when you're reading the book, take notes, see what I've written down, add to it, and then try to get the second and third tier, and then bring those notes to the class. Where in the class we'll be discuss the areas that you don't understand, and after that, then look at this video. When you look in this video, I will go faster than the book. The author does a great job by explaining it in more detail with examples. Anything in finance, or any kind of math problems, any math, once in a while I teach a math class, you have to be able to sit down and logically understand what's going on. Not just plug in the numbers. That's what you do in a calculator. That's what you do in your spreadsheets. When we go down, halfway through, you'll be utilizing some spreadsheets. And when you utilize the spreadsheet, just plug in the numbers. But just don't plug in the numbers and get an answer. I want you to understand, what does that answer mean. You will also, when you're utilizing spreadsheet, look up on top on the formula, see how the author set up for lack of a better word, set up the problems. Okay, remember this course going. There's a lot of information. You already had accounting classes. You already had corporate finance, which is a prerequisite to this course. And so you have the basic understanding. Now going international finance, you're going to take the leap. How do I operate in maybe another one country where I have a subsidiary, or multiple countries? The way the book is set up, it's set up from a perspective of a multinational corporation, or MNC. And but the same strategy that you're looking at, not only entering into the international market, but working with the international market through what we're going to talk about, exchange rates, and other factors that are involved through the chapters that we go through. You could utilize that from small business entering a medium business, or even a larger business already probably in that, but it gives you a good review, a good baseline, so you understand it. You're not going to learn everything within this 8 weeks if you're taking me, or 16-week course, but it'll give you a good general understanding of what's involved, the different aspects, the different factors going into international business. Other than your product and market, remember, as a finance class, you're looking at the dollars. Does it make sense? When do I move my dollars? When do I expand? When do I contract? Oh, how does my cash flow or fund flow from one currency to another currency? What's the conversion rate? So the first, I think there's 20 chapters or 21 chapters in the book. The first 10 chapters, if I'm mistaken, is at a macro level, looking at the, what do you call it, the nation, or the countries, to get a general idea, as a larger view. And then the last 10 chapters are more of a micro, going more down to the MNC. How do I operate, and what do I do internally? Okay, so we're going to start. Now, remember, you already have my concept maps. If you just happen to pick me up on YouTube, try to sign up for the class. Either I teach at Harper or the College of Lake County, in Illinois, or you found this and you're having trouble at the class school you're taking at, and this is a supplement. Remember, it's on the YouTube, but try to go to the schools, to the community colleges. They're a good resource, a good bang for your dollar for small and medium business, even larger businesses, to train your employees, to give them a basic understanding, or to do professional growth within your organizations. You're already paying taxes. Remember, as a finance manager, you're going finance. National, you're paying taxes. Let me reap all the benefits for me to by paying the taxes, and this is one of the benefits. The community colleges, the cost is offset depending on the percentage and the state that you're at through your taxes. Not only through individual taxes, the constituents in that state, but also the businesses that pay taxes from that state. So you could utilize the community colleges for your employees to gain better understanding. Or I know Harper has a business industry section other outside of the traditional colleges courses that could be very fine-tuned or specific towards your business operation by bringing in experts or people from out of the field, either through the Harper College or through the SBA, Small Business Association, that most community colleges have a very close relationship with. Okay, so let's go into it. I changed it a little bit different. Remember, those of you had or looked at the other chapters, if you're in there, what you're looking at. So remember, after you've read this and come back and look at the video, when I open up the concept maps to all the tiers, the different levels, more than level 2, and see how much you picked up out of the reading, out of the lectures, and see how close you are to what the notes are. And my notes basically reflect more of what you've been reading. I'm not changing, I'm not throwing in, I give you my own verbiage in there, a little bit verbiage, my own understanding, but I try to keep everything close to how the book that you're reading, because remember, the community college or just an introduction to international business, it's a baseline. Assuming you have no baseline, some do or not, but now it's just so I try not to confuse you. I follow along with what the author is presenting and try to utilize this as a supplement to make it a little bit clearer or to summarize everything at the end. So I'm going very fast. Now, I've been hitting about an hour 15, hour 20, an hour and a half. I'm trying to make this down to at least under an hour. But with finance, there's so much going on. There's so much you're going to learn. There's so much vocabulary. I'm looking more at strategically, so you start thinking. The math you can do through the formulas. You'll do well when we're doing the math and the problems the author has. But you have to strategically understand what's going on. Here we're going to be talking about certain exchange rates, what's the exchange markets. We're going to talk about different movements of the exchange rates from an exchange. All right, so let me just go for it. What are you going to learn today in this chapter? The other thing I want to just add on, and I've got this already out there, so open up your concept maps, and now just follow along right in there. Remember, I'm only giving you the second tier. You have to add in. The more senses you use, you write it, you hear me, you read, you've read it. Reading should be your first exposure, not the first exposure to this YouTube. All right? So here's the exchange rate. The exchange rate movements are measured. How the equilibrium, so you're going to look at explain how the exchange rate movements are measured. You can do. You're going to try to explain or understand how the equilibrium exchange rate is determined. You're going to look at factors that determine the equilibrium exchange rate. Let's move this over a little bit, okay? You're going to look at movements in the cross exchange rates. We've talked about that in the previous chapters. Financial institution, basically banks, it doesn't necessarily, but let's just stick with banks, it's easier at this level, attempting to capitalize on anticipated exchange rate movements. Remember, I know something's going forward. Banks are the ones that are chief financial manager, whether it's domestic or international, you know something's going on. Right now, a lot of people are wondering, the Fed, the Federal Reserve, which would be the central bank here in the U.S., there are other central banks in other countries that you, in this course, you'll find out through research, depending on what country you're going to be operating, your subsidiary, or you're going to be opening up business at. So you're looking at that central bank and to get a general understanding. Okay? So the Federal Reserve is looking at raising the interest rates, and you're going to find out that has an impact, whether it's a downward pressure or an upward pressure on the flow of money, depending if I'm from outside the United States investing in, or I'm in the United States and exporting, importing. So it has a different ramification. You have to look at the source. The way this book is set up, it's looking at MNCs, multinational corporations, from a U.S. parent. I mean, I am a U.S. owned operation here in the United States. There's a lot of companies that operate in the United States, but may be governed, for lack of better words, from an international outside. Okay. All right. So that takes care of an overview, real quickly. Overview. Okay. So let's look about measuring exchange rate movements. Remember, I am looking at, and a lot of the whole thing you're looking at anticipation. The move no different than if you're doing those. I'm not gonna I'll just read it, talk lightly. If you don't understand what I'm talking about, I assumed you picked that up in corporate finance, in accounting, or introduction to business courses that I've taken. If not, you'll still do fine. It's the prerequisite is corporate finance and I think in accounting. But if not, you'll do fine. You just have to read more. Remember, when you're reading a book, it has a lot of information. Read, especially in finance, or finance or any kind of math or stats. If you're going to be taking stat class, you have to, for lack of a better word, sit down with a clear your mind and try not to do the whole chapter. Read a section. Oh, I understand this, and move on. If you're stuck, look at it. Go back. Okay. All right. So let's look at depreciation, and we've learned that in accounting. Everyone knows the depreciation by a new car. You see all the commercials on TV. I bought a new car, named her Brad. I named him Brad. And within 2 days, I got in an accident and I already lost some money. Now, currency depreciates. Cash flow depreciates over time. A little different than a car, but same concepts. It's an economic terminology. Okay, let's see. Decline in the currency value. So right, so the currency is not worth anything. It depreciates down. Could be because of inflation or other economic factors that are affecting it. Now, appreciation, increase in the currency's value. The value of the currency goes up. We talked a little bit last chapter about Greece, and a lot of their currencies really depreciated high. You know, because they own all the creditors. But now that they got the bailout from the European Union, the central bank, and provided them some additional cash to be solvent, but they had to follow the terms and condition of that advancement, for lack of better words, to put back, cash back into their economy or into their banking system through the central bank of what you would be called the Central Bank of Europe, for lack of better words. Okay? So now the value went back up again. That's all I was trying to come around there. Now comparing foreign currency spot rates. We talked about spot rates in the last chapter. So just remember, that's when I'm buying it right now. It's very liquid, and the only thing, just little things. For spots, for liquidity, I had to have more people, a lot of buyers and sellers. Otherwise, if I have one or the other, it's not very liquid because no one will be able to buy it or no one will be able to sell the currency. Okay, so comparing foreign currency spot rates. I just, as a reminder, I'm trying to remind you. I'll throw in a little bit what you had in the other chapters to tie it in, or what just as a general baseline. But I'm not going to go into real detail because you already went through the chapter. You just have to go back in the chapter and read if you don't understand it. If you notice, remember the way I teach, it'd be the same way I'd be teaching in the classroom. I'm not reading the script. So sometimes you may say, well, he's going back and forth, doesn't look whatever, but it's the way that I think is more applicable, more personal from my style of teaching to your style. I've adjusted, put in a little more visual for you to retain information. I'm more of a visual person. I like to see it. That's what math is. If I could see what's a fraction, what's a quarter, remember how to teach it. Here's the circle, here's the quarter, you got three. So you visually have to understand it in your mind. That's all math, no different than reading. So, but you have to take your time. Okay, so what we have is the formula. Percentage change in foreign currency, and then you're going to look at, here, let me go in here. This is spot rate. It's just, I'll throw it in there, but I'll put this in. Now, a lot of times I may open up this section and just briefly talk about it. I may not go word by word, because you could read it. So the way you utilize it after you've done, read it, wrote it on your own, added to it, and then went to lecture and everything else, you'll come in here and see, hey, did I put this in? And put in your own verbiage. I'm trying to do a verbiage. I'm going to say verbiage. Some of the definitions or the key words or concepts that you see here has to be specific because that's how you communicate. But you may not need all the sentences. You may just say a spot rate. And that's all you're going to need because you understand what the S is. You know what I mean? So this one is S is spot rate, and this is spot rate at an earlier time. That's all you're doing. You're subtracting one. Okay? All right, now positive percentage change indicates that the currency has appreciated. It went up. Makes no sense. It's worth more value. Negative percentage and it depreciates, goes down. When you're going to find out with the currency of a government, it is very unstable, for lack of better words, or because environment, what they call very. Let's leave it at that, and I'll just go on and go into the definition, so you could see the word and hear me explain it. Okay, in the case it's appreciated. Okay, now if I look at Exhibit 1, and they're just looking at the, how the exchange rates, movement, and volatility, and stability are measured, for lack of better words. Okay, so we're doing good on. Okay, so now, look at the numbers. Look at the dollars. And these are different. I think it's one, and this one is different. The value of a Canadian dollar, the value of this, and what's the change. So you can see the changes were, here's a positive change, which is good. Okay, here's a negative change. And remember, you're looking at from an exchange rate is when I'm flowing currency into the subsidiary or bringing currency out, it's the conversion factor. How much is going to be positive and negative? So timing in finance is very, very important. You have to know, but you're looking at trends, and there's other sites. Remember, I got the website. You're looking at certain trends, and you follow those trends. And even though you're doing a lot of anticipation or assumptions, and you're trying to predict where you think this is going. If it's going downward, when do I get rid of it? When do I sell, or do I hang on to it? No different than you're buying stocks. The company going up, so you want to hold off to the last minute. But when it's going down, you don't want to you want to get rid of it fast, but you don't want to jump the gun. Okay. So look at the chart. I'm not going to go into it. It's easy reading chart. When you read the book explains the different sections and how to view it. I'm just throwing it out there. The other thing I want to always bring out here, I have websites. I try to encourage you to utilize the websites. I understand that students, and I'm just as bad, the websites are there, but they're not going to click on them because it's going to take me too long. I'm reading, whatever. For you to understand thoroughly finance, there's a lot of websites. You have the Federal Reserve, you have the Bank of International Settlements, and you have real-time exchange rate quote. These are sites that you could go in there, and what I usually tell you, if you're going to finance is your major, or even international finance is your major, or international business or marketing, a lot of these sites are good sites for you to save. Those of you going, you're at community college, down the road you may be going for your bachelor's, and you're going to need these sites. For resources. Why find them? These are all credible sites once you looked at them. Or even if you're in a business and you're looking at the sites, how do I know what the interest rates are? Here are the sites, and so you save them. And there's a program called EndNote for those of you going for your master's or your or your PhD. EndNote basically keeps all your information. You could categorize it. So when you're doing your bibliography for your dissertation, or even if you're doing anything you're making, or a white paper, it's a business research paper by PhDs that's presented strictly to business to address a certain issue. It may not be what they consider academic, because we're not trying to sell books or anything else. We're looking at a problem. Remember, in business, when you look at business management, you have some that are very looking at in the future. Majority of business individuals that finish with their business PhDs or their MBA, they're actually looking at, I've learned this, it's not like some conceptual in 50 years. How do I take this application and able to infuse it within my organization, within my process that I control? So the Federal Reserve, now the Federal Reserve is a government site, and it's pretty good. It gives, but remember, any kind of sites you're looking at it, you're looking at the perspective or the mindset from whoever is creating the site and controlling the site. There is some bias, hopefully for the U.S. Okay, so it's the current and historical exchange rate. And now what I'm going to do is just click on it. Just see the Federal Reserve. Going a little slow here. Okay, so look, they've got overnight for AA, non-financial. They have read more. They got information. They got aggregate depository information. You got foreign exchange rate. Just one. I'm not going to go into it now, but look, you have payment systems, consumer information. You have reporting forms, news events, and if I'm not mistaken, here you could also sign up for a on the mailing list. As a student or anyone that's in finance, be on the mailing list. So you have on their email so you could find things out about it. So look at the site, play around the site, see what's there. Federal Reserve and some of the other sites I'm going to show you, they got videos that may explain it a little different than what the author is doing, maybe a little different than me. Everyone, we're all unique, but we're thinking differently. We still come up with the same conclusion. I may like percentages, you may like fraction. What's the difference? It's the same thing. What's a fraction is converted to percentage so we could utilize in our calculator, in our spreadsheets, but it's still the same number, the same proportion, the same relationship with it. You're going to end up with the same results. Only, look, if I'm looking at Fahrenheit or temperature or centimeter temperature, we basically are just, it's the same thing, it's just the number looks a little different, but it gives me the same results. All right. Okay, so we have that. The other one I have in here, a bank of settlement. That's a good one too. Remember, so you keep the information, categorize that. It's a bank of international settlements. About, let's see what they say. Let's see a bit. Established in 1930, so it's been around a while. And for the National Settlement is the world's oldest international financial organization. Got it spelled wrong. Geez, you would think they'd catch it. That's okay. The BS has 60 central banks representing countries around the world that together make up 95% of the gross domestic product of the world. So they're looking at it. So this is pretty good big. The mission is to serve central banks in pursuit of monetary financial stability, to foster international cooperation, fostering discussions, supporting dialogue, carrying out research, acting as a prime counter party for central banks for their financial transaction, and serving as an agent or trustee in connection with a national financial operation. So there's a lot about them. So they got the history. So there's services in here. They also have, I think, for students, they have some videos. Most of them have videos. Let's do the search. Certain aspect. We're covering a lot, but you don't understand that one thing. Let's see if you not understand how the supply curve moves with that we're going to be talking about with the exchange rate. You understand the supply curve and everything else, how it moves in the economic system, supply and demand. The same thing comes up with your exchange rate, right? The exercising price that you're going to be paying. Okay, so read it. I open it up. This way you're forced at it. What's going to happen in the future, the publishers are going more with electronic books, e-books. The e-books, I'm still old-fashioned. I like flipping the pages even though you got the noises. But the e-book makes it a lot more interactive. I've got the tablet, you save some paper, you got the ebook, you could click it on, and then when you have the site, you go instantly, like I'm doing here on here, okay? So he takes that, and yet on the real-time exchange rate quotations, I won't go into there. Okay, so we did pretty good on that. Okay, so now that took care of our what was that? Measuring exchange rate movement. General idea. This is just a summation. What did he say? I don't understand that. Here's what you're looking. Here's how you're measuring. Read the book. Take your time. Go back. Stand this. Go back and flip into the book and try to get it, and then try to find or go into one of these sites. The author has the websites located right in here. If you had the concept maps, or if you the both community, a lot of community colleges have a Blackboard course management system. There, the instructor, hopefully, in your class will have a whole bunch of links to these. The publisher also gives you links to these sites. Save them to their life source, the way you know what's going on. You don't have to go through all of it. You understand what country I'm working on, and that's where I'm looking at the movements or exchange rate. Similar to what you'd be looking at following the stock of a domestic company. You're looking at how many people bought it, what's the activity going on with them. Okay? All right, so we have that. The next one, let's look at the exchange rate to equilibrium. Okay, the exchange rate. Basic definition, I'm going to move this up here. The exchange rate represents the price of a currency or the rate at which one currency can be exchanged for something else. So I'm going to give you $1. How many euros are you going to give me back? It depends if the euro is stronger than the dollar or the dollar is weaker than the euro. I may get more euros or I may get less euros. But it's not like it's, remember, we went from a fixed exchange rate structure that we've talked about last chapter, and we're going to a floating exchange rate structure to represent uh, the market, so it's very fluid. Okay. Okay. Now the demand of the currency. The demand increases when the value of the currency decreases. Okay. So if I'm looking at so the demand for the currency increases when the value of the currency decreases. The U.S. MNC can purchase more goods since the pound is lower than the dollar. In Exhibit 2, so here we go. When I'm looking at the demand, all right, so here's my demand scale, okay, lower than the dollar. Demand schedule for British pounds, the D, okay, no problem. It's just like when it's similar to the demand curve, the equilibrium price when you looked at the supply and demand. Only now you're looking at the supply and demand of currency. Okay, so we have that. And supply curve for the sale increases when the value of the currency increases, leading up to an upward sloping supply currency schedule. You can buy. You can now buy. Geez, I think I created this last night. You can buy more currency, and here's where I'm looking at Exhibit 3. So now I have. There's my supply curve. Remember, it goes up and down this way, and demand curve works this way. All right. The schedule supply. Hey, this almost looks like economics. I remember this. Hopefully you do. Equates the quality of the pounds demanded with the supply of pounds for sale. No problem. Same thing you have. So this is what you would call your equilibrium exchange rate determination. Here's what I think is here's where I think if I look at equilibrium price or equilibrium exchange rate, how much demand for it, how much supply, so it moves, and this is the price, $1.55 in this case here. Okay, for the value of I think it's a euro, or yeah, in the quantity. Okay, for the British pound, a pound. Sorry, I keep on forgetting that United Kingdom is the only one that still is utilizing the pound versus the euro. Yes, a different relationship when they're working in that. Okay, now change in equilibrium exchange rate. So if I'm looking to change, okay, here now I have it. Now I've put some more arrows in here. I'm more of a visual person. I've done this to help you see up and down. So not only the words, so when I'm looking at increase, remember it's one way of learning, increase in demand schedule, right? There's more demand. The banks will increase, the banks will increase the exchange at the level at which the amount demand is equal to the amount supplied. Remember, I'm a bank. I'm making money. Any transaction, there's some cash involved, or a service fee on there. There's the amount supplied to the foreign market. There's a demand for it. The bank to satisfy the customer, whatever needs, because there is a product or service I provide as an intermediary. So we have that. Now, to decrease in demand schedule, what do you think is going to happen? Decrease in demand schedule is going to happen. The bank. I don't have as much. I'm going to reduce my inventory, for lack of words. Some of you have taken me for retail management, and there we've talked about the accounting process, about the inventory turnover. Same concept, only now I'm turning over cash or dollars, or from one denomination to another, at the level which the demand is equal to supply. I'm not going to go through that. Now, if there's an increase in supply, the banks will reduce the exchange level. Remember, there's more supply than demand. I got to reduce it. Correlation. Decrease in the supply level, the bank will increase the exchange level to the amount that is demanded. If the supply is down there, the bank has to get more currency or whatever, because there's a decrease, the safety stock. You start thinking, it's not that hard in finance. It's the same concept you've learned in every day. So when the supply goes down, I got to pick up my supply. Look at the cash and the currency as an inventory, for lack of better words, okay? And I've got this with that. Okay, so we're doing pretty good. Now the next one, what factors affect the exchange rate? And look at the exchange rate. If I'm looking at the banking system, when they're going to rate the interest rates, right? When the banks raise the interest rates, the rates that they charge to, the discount rate that they charge to, or the interest rate that they charge to other member banks, right? It's like the exchange rate. Well, what factors? What's going to affect it? Okay, right now we're in a slump, a recession, so the bank keeps interest rates lower. They raise it up. Remember, we're talking macro in this next 5 or 8, 10 chapters, and macro is at the larger. What's happening with the government? What's happening out there in the market? Remember, I'm a MNC. I look at an MNC as I'm an individual now trying to buy stocks or sell stocks or buy bonds or whatever. Either debt financing or equity financing. Okay. So factors that influence it. Let's see what we have. Ooh, we have the web. Oh, I always have the web. What do I have here for web? Datainflation.com. And here's just a site. I'm not going to click on here, but you could go on the site. You have the site. It just gives you some information. Remember, I do the site. I'm going to throw a couple in there. The government sites are always consistent, constant. You know what you're going to get, but they may not be as interactive. Federal Reserve site wasn't too bad. So they may not be as interactive as some of the other sites that will give you more because they want you to come in there buy the service. So, look at the site, but some sites you may feel very comfortable with, other sites you may not like. So yes, but you keep it for reference because you may get 1 or 2 things out of them that are more has a higher quality that the other ones may not have. Okay, what's the formula? Geez, look at this formula. Okay, factors. Okay, so I'm looking at my what are we talking about? We're looking at the equilibrium exchange rate. There we go, factors, and then this is just a formula. We're looking at where I'm not going to go through that. Changing the differential between U.S. and foreign countries. All these are just interest rates. Remember the symbol if you got this change of. Okay, and we'll go into each one of these. But this is the formula. Just have them all in here, put them in there, and you'll get an answer on that. So what is it? But these are factors that you have to put into consideration when I'm looking at what I charge for my currency or product. What's going on in there? That's what makes it stronger or weaker. Okay, and you'll find that out. Okay, so I got rid of that. Okay, so that's my web. That's my formula. Okay, now I just went this 1, 2, 3 because a lot of times I'll go through here and I go back, I get talking, and then just I'll leave them open. All right, so now you had the formula relative inflation rates. When I look at relative, what's current? Relative inflation rates increase in the U.S. inflation. Boom. Okay, that's gonna affect that. Leads to the increase. I got an arrow. Leads to increase in U.S. demand for foreign goods. No problem. Increase in U.S. demand for foreign currency. If I need foreign goods, I'm converting. Even though I'm paying by dollars, it's in that country they'll take my dollars and they'll exchange it to the denomination there. Even though I may not see it, but electronically done, or if I'm buying there and I'm paying cash with that currency. Okay, an increase in exchange rate in foreign currencies. Okay, so relative inflation rate. Now here is how this looks. As easy as it can be. Now I'm back in the pounds. Okay, impact of raising U.S. inflation equilibrium value of the British pound increases the demand D2 and supply. Do you see what I mean? So here we go. Upward pressure. This is D, this is what's at, but now because something happened in the U.S. demand, increased U.S. demand or increased inflation, any of those factors will move my whole thing going forward. My supply goes up and my demand goes up. Okay, so it's upward pressure in a pound. All right, now relative interest rates. Now, again, we're talking about the relative interest rates as we were here, right? Inflation rates here, and these are the interest rates. So this is inflation, excuse me. Gotta remember there's a lot of information here. Change in equilibrium exchange rates. Okay, and we're now at relative interest rates. I'm looking at the interest rates versus inflation rate. Either one, or it could be all of them at the same time. Increase in the U.S. rates. My interest rates are going up. That's what's hopefully, well, it depends. If I'm a borrower, no. But if I'm an investor, yes. Okay. Leads to an increase in demand for U.S. deposits, a decrease in demand for foreign deposits because mine's going up. The only reason people from the U.S. go outside is because I get a better return on my investments or dollar if I put in this bank or I buy that security versus something here in the U.S. because they're so low, for lack of better words, leading to an increase in demand for the dollars. That means any more dollars to buy. Increase in exchange rate. Okay, so here's the exhibit. Now I'm going Okay, so what's happening? Relative interest rate. What's going to happen? The pound is going down. Remember, everything is in relationship. And the other chapter is from the dollar. We're looking from the dollar's perspective because I'm a U.S. MNC, multinational corporation, and the parent company's here. So the dollar is my base, and I'm looking at everything else as offset or a relationship to the dollar. The dollar is my primary. So when I'm looking at the pound's going to go down, right? You see what I'm talking about? It was at 155, equivalent to the dollar. Now it dropped down because our interest rates went up, and so I don't have to. The money's not flowing out of the country. When you look at the macro perspective, you're looking at your bank account. Where's the money flowing in and out? So look at the U.S. Treasury or anything else. How's their money flowing in and out? So if the interest rates are going up in the U.S., that means investors are going to come in here, you know what I'm talking about? So they're going to have more pounds in here. I don't have to worry about them, right? All right, but so I mean, I don't have to take my, some investors will still come in here, but I don't. My money's not flowing out. There's more money flowing in, so that's putting a downward pressure on the pound. And I don't need the pound anymore. People come bringing the pound in here. So if I'm looking at this, what happened? You see the D2 moved, and the S2, the supply, went down also. Didn't go up. You see the X, instead of going up, it was downward pressure. And then when we talked about the Fisher effect, the Fisher effect is when I'm looking at relative interest rates. That's why I want to throw it in there before. Another thing, what is the real interest rate? Remember, relative, here's what's the interest rate, but what's the real interest rate? You know what I mean? High rates, because there's other things I have to put in consideration when I'm looking. What's the yield? What's going on? The real. What's the real? It's no different than gross and net. I'm trying to get concepts so you can kind of in your mind visualize. Remember, my whole process teaching this is for you to start thinking financially, but thinking, forget the numbers and everything else. What is going on in the market? Once I understand that, then I could easily solve, look at this as a word problem and easily convert it into a mathematical equation. Okay, so it's called real interest rates. High rates may reflect exception of high inflation that we talked way back up there. I'm not going to go back up here, which would cause a downward pressure on local currency. So I take the real interest rate equals to the sum of the nominal interest rate minus the inflation, and now give me what they call the Fisher effect of real interest rate. Okay? Now, relative incomes. Remember, these are all factors that affect the exchange rate that we're talking about. Remember what I'm looking at here? Factors that influence or affect the exchange rates. Okay, now, so we have that. Now let's look at relative income. If I'm looking at relative income, increases in the U.S. If there's an increase if there's an increase in U.S. income, right? That means it goes up. Increase in U.S. demand for foreign goods goes up because I got more money, and they may not have it here. I want that exotic wine, or I want something, whatever you're going to buy. You know what I mean? Increase demand for foreign currency related to currency, or now I've got more. My income went up in the U.S., so I'm going to travel more, tourism, and I want the denomination in the country I'm going into. Increases in the exchange rate for the currency. Supply stays the same, and I'm going to show you another thing. British firms increase investments in the U.S., exchanging pounds for dollar. All they're saying is, when I'm looking at this, remember, so what was this? The income went up, the demand shifts, right? For the pound, goes up, but the supply doesn't, because I have, even though I need more pounds to buy, okay, but what happens is that the supply doesn't, because now, since I have more income and my inflation's up there, there's the force that keeps the supply. People are investing in here, or selling, or buying products in here from for lack of better words, from the UK, Britain. So it keeps the supply the same. Because look, when I look at supply, you have to look at currency. dollars coming in or pounds coming in. Look at it as an inventory. Look at it as a commodity. That's what it basically is, a commodity. How much dollars should I have? Even though it's electronic dollars or paper dollars, hard currency, it doesn't make a difference. It's a reflection of what is in that account. Look at a bank account. I don't see dollars. I don't have like $1,000 in my bank account. It just says I got 1,000. So many units. But I could take those units and convert them to dollars. Okay? Do you see what I'm talking about? So demand is the only thing that shifts. Read the book. The author explains the supply. Same British investors invest in U.S. exchanging the pounds. So there's more pounds in here. Okay? Okay, now government controls. That has a big effect. Again, it has a big effect on influencing exchange rates. If I'm looking at imposing foreign exchange barriers, I do something that I try to minimize it. I think China is kind of guilty a little bit of that, but they're learning the free market. You know, people say foul play, but people say foul play. Okay, I'm adjusting it, but we don't want to upset China too much because we owe them too much. It's like upsetting Citibank or Chase if you have outstanding debt or a loan or something with them. But you want them to play fairly in the market. So they're going to try to do it. So they got some kind of controls. We'll talk about how we play fairly in the world international finance in a few, about 5-10 more minutes. Imposing foreign trade barriers. They're doing something that's upsetting something, so either they're kind of controlling it. It's not really the free market forces working, buyer and seller. It's more like a monopoly, for lack of better words. But like I said, we don't want to upset them because there's a whole big market there. They got so much potential for growth. Let's kind of prop them a little. Hey, can I get a better deal? What about this? It's not fair. But look how many Chinese or any country you're at, there's a potential for growth. Intervene in foreign exchange markets and affecting macro variables like interest rates or inflation or income levels. The government could do that. Okay, now some expectations. If I'm looking at an impact on favorable expectation, what's going out there that have favorable expectation for either my currency or the subsidiary's currency where I am located as an MNC? So favorable, let's look at this one. Write it down. You've already written a lot of this. First exposure book, you took your own notes or utilized this notes, you added into it, we talked about it in the lecture or in the forums, and now you're looking at what did I miss? I got all this, man. You're taking good notes. You're understanding how to convert. Remember, you have the PowerPoints, everything else from the author. Does a great job. The PowerPoints are a lot of slides. To look at each one, a lot of verbiage. Your mind goes, this is real quickly. You could see it. That's how the mind works. So that's why a lot of instructors or a lot of in business we utilize mind maps or concept maps. See the whole concepts on one page. Okay, so investors expect interest rates, or anticipating interest rates in one country to rise. They may invest in that country, right? Oh, there's potential. There's a market for it. There's a need. Okay, leading in a rise in demand for foreign currencies, favorable. Increase in exchange rate for that currency, favorable. It's going to cost up because more people, so I get some. I'm paying some kind of costs associated with that. Okay, now unfavorable. What do you think is going to happen? Impact of unfavorable expectation. If I think the market's going down or the country is going to go through a recession, I start pulling out my money. No different when I think a bank is going under. Or if I think that my supplier is going under. Either buy more, right? Or I buy less. So, right? So speculators, not MNC speculators. There's people out there just speculating. It's going to go up. I buy it now, and I buy it at this price and sell it. I'm making that marginal cost is mine. But I could lose it, or I could do even. So I'm speculating, I'm buying it. I'm not keeping it for a long time. I'm doing like flip a house. I'm buying a house real cheap, and hopefully it's going to go up in the market. If it's not going up, let's tie this back to finances. Some concepts so you can understand what's going on. Remember, look at the dollars, look at the currency as a inventory, a supply of goods, for lack of better words. Okay, so if I think that I buy it good, but the market's not there, do I sell it the low thing? No, I will wait. I just rent it out, and when I rent it out for a while, and then when the market is favorable, remember, finance, the whole thing in finance, what you can do is terms and condition and timing. When do I sell? When do I buy? No different than the card games. When do I hold them, and when do I fold them? Yeah, throw a little humor in there. Otherwise, you'd be falling asleep on it. Okay, so they expect to depreciate. Respect the speculators. They're not there for the long haul. Quick money. Sometimes they make it, sometimes they lose it. They're speculating because now they have the control of the goods and they can sell it right away in a higher cost than what they paid for. Okay, impact of signals on currency speculations. Speculators may overreact to signals because they're buying too quickly, causing currencies to be temporarily overvalued or undervalued. And sometimes you wonder, you got to be careful in the international market. You have large people have money, they may do some kind of buy a lot of shares that really have no value, but other people in the market, because a lot of things are on computers and not analyzing, all of a sudden there's more product sold, so someone's going, hey, there must be something going on in the market. We don't know what it is yet, but let's start buying it. So, until the market says, wait a minute, we just got taken for an advantage. But the speculator may create the thing intentionally or unintentionally, but it's going to create a demand one way or the other, or a sell off. So be careful. Overvalued or undervalued currency. Okay? Now, interaction of factors. Some factors place an upward pressure, while other factors place a downward pressure. Exhibit A, and there's different factors. We're talking about summary how factors work. Right, so traded or related factors, inflation, income, right, financial factors, interest rate differential, capital flows, exchange rate expectations. Okay, exchange rate between foreign countries. Just visually look at it. I can't go through everything because it'll be an hour for me to explain. In the classroom, I will go explain it, but it makes it easier if you've already read it and looked at it, not just read it, so I don't understand it. Look at it, comprehension. There's all these different words, it's hard. Come on, you already went through accounting, you already went through finance, you already have that mindset if you're taking this course. If not, you will by the time you finish this course. All right. So let's see, influence across multiple currency market. A lot of multinational organizations have operations in different markets. They may have the supply here. They may have a distribution warehouse in this one because it makes sense. Here, the manufacturers here because of the labor costs, very labor intense, or whatever. So they have distributions or facilities at different, direct investments in different countries, different regions. So now what I'm looking at is influence across multiple currencies. Well, is that important for me? Common for European currency. European currency. Greece had a problem. All the other markets, even though they're, I think there's 17, they start off at 13. Original in the EU, similar to the United States. We start off with 13 colonies. Let's look at 13 countries. I think there's 17 now. For a while, it's going to be back down to 16 of Greece, but Greece is still hanging in there. But it may shake out after a while. It's still growing. We didn't become a country, a solid country after a long time. The European Union, I think it was back in the 1970s or whatever. I forget what. I'm not a historian. I'm not too worried about that. But remember, they haven't been around that long, so they're still developing. They're still working. They're trying to give up their own identity or their national, their own country, and become a European Union. Just like I'm an Illinoisan, but you may be a Wisconsin, but we're all Americans. Okay. But I have my own identity. I don't like whatever. Okay, I'm teasing. I'm trying to make it go on. So if I'm looking at so influence across multiple currencies, markets to move in the same direction. They're controlled by the same central banking system. Influence the liquidity and exchange rate. Currency spot market means I could go on there and buy right now. I need somebody. I go to a bank and say, the spot market. Look at this. I got to buy a car. Go in there right now. You could wait to see the price is good on sale. No, I need it right now. Here's what the spot market. I got to buy it right now. So currency spot market is liquid as long as I have many buyers and sellers. Keep on bringing that up just in case you hear it on a question. And then, hen. It makes you wonder. Come on, I catch my own errors as I go here. Then its exchange rate will not be highly sensitive to a single large purchase or sales. Remember, because it's more the liquidity. The spot rate is liquid. You don't have to worry. Exchange rate will not be highly sensitive because I have more buyers. The only times it becomes highly sensitive if I have less buyers and more sellers, or I have more sellers and less buyers, vice versa. Okay. Again, like I said, I'm not trying to. I'm just giving you a general idea, something to think about. All right, and I'm not reading off the script, so here we go. Okay, we're doing pretty good. Okay, now cross exchange rate movements. What you're going to do in this section when you're reading that, there's problems. Remember, you're taking me at a college level, community college. I will give you homework assignments to learn the math part. You have to understand the math part. Use Excel spreadsheets. Do I remember all the formulas? No. Does anyone remember the formula? So, yeah, maybe there are some very people that remember all the formulas. Most financial managers, I know them now, but if I haven't touched them before, I forgot, or I have them in the spreadsheet. But once I see them, it pop up. I may make an error, I could work it out. Why do that? I had the formula set up. I just have to make sure, just like accounting, right? I plug in the numbers, but I have to understand the correlation, the relationship, what that number's telling me. So you do the homework to go through that, and the homework is, there's an answer. I give you handouts, the author, the book goes step by steps, or you could do on other books, a supplemental book worksheet to do the homework. The whole, most of the stuff is done through spreadsheets or through a calculator, but you have to understand what does that number mean when it comes out. Again, I'm going to go on math. When I go 25% or 0.25, I know that's 1/4 out of the whole thing in my mind. I don't have to put the numbers because that means something. What does that mean? If I only say it's 25%, I don't have no clue. I understand from a whole there's 100%, so 75% isn't there. I only got this little piece of a pie. Almost brings back from grade school how you learned that. But you see how that's stuck in your mind. It's in there. That's what you want to do. You want to see that visual. Just like when you're reading the word, a lot of times you can read the words. It's so confusing. But when you see it in a mathematical formula, the equation, it's easier. I see what they're doing. Okay, so I want you to understand that, but now I want you to understand what's going on. What's going on? So the numbers make a difference. What is the negative? Well, how did it become negative? What's happening with it? Why is it going up? Why is the supply moving? What's not moving? Is it going to cost me more? Do I buy it now, what they call hedging, or buy in the future, or what we talked about, forward contracts or future contracts? That locks in my exercise price or my exchange rate price. But I could lock it in, but then it may never materialize. People buy, when you look at the future market, we'll be talking later on when we go into micro. People buy oil in the future. A lot of large corporations buy oil now when they think the prices are low. Okay, so they buy a lot of it, but if they didn't use all of it, they could still sell it and make some money because they got their inventory price is lower price. But if they think they're anticipating that price is going to be like, let's say $75 a barrel. I think it's a little lower now because there's a lot of things going on. You got Iran, it's going to be, they're going to lift the embargo, so now you're going to have a flood of oil because they need cash to bring their economy in. So now you're going to see the down pressure. The oil prices are going to go down. So but I locked in. I didn't know they were going to do a settlement with Iran. All right, I'm a multinational. I'm very heavy in transportation. I'm a transportation, UPS or something. So they buy all their things at this price in the future, and lock it in. But what happens? The price never materializes. So now I'm paying higher premium costs, and I don't know how to get rid of it. So I'm hoping maybe something happens that the prices go up, and but it's an assumption. So you have to look at it. You're taking some gambles. You're taking some risks. You're taking some assumptions. Not like a speculator that is doing it just to those short, quick movements to make it quick and get out of there. Okay, so let's say cross exchange rate movement. Okay, let me do it this way, just to bring it in, so you can always see what I'm talking. That's why I like the concept map. You see where I'm at. Okay, explaining the movement. So when I'm looking at this, changes are affected in the same way as the types of forces that we talked back there, factors affect the demand and supply condition between two currencies or countries. Remember, look at the currencies as an inventory of a good, as a tangible thing, the supply. If currencies A and B move in the same direction, there is no change in the cross exchange rate. No change. We're moving consistently. When currency A appreciates against the dollar. So let's say this is the pound against the dollar. Maybe I could put that one. They do AB, so I don't want everyone to think it's only the European Union. It could be the Japanese yen or yen from China. You know what I mean? So, or the ruble or the zloty. Or the mark or the baht, from India. So it doesn't make a difference. What currency am I looking at? We're going to later on talk about the global, has effect economically, but I'm only dealing with this one country or several countries, in this case. So in currency A appreciates against the dollar, by the greater, smaller degree than currency B, which should have been the dollar anyway, okay, then currency A appreciates or depreciates against B. Okay, so A, I should have went with here. It's probably what messed you up. All right, I'm gonna put the dollar in the parentheses. I was trying to bring it back more for you to relate to. Sorry. Okay, I'll correct that later. All right, good. And like I said, read it in the book. The author does good, and then bring it up in the class, and we'll discuss it. When currency A appreciates or depreciates against the dollar, one goes up, appreciates, right, and one goes down. When we look at this one, while currency B is unchanged against the dollar, currency A appreciates against the currency B, the same degree it appreciates against the dollar. So my things, you got two currencies, a multi, for lack of better words, multi-countries. So I was right on this one. It's always against the dollar. Okay? So we'll leave this against the dollar. Now, you see, I figured myself out while looking at my own notes. But I understand what's going on. And that's what I want you to do. Listen to me, look at that. And I don't want to confuse you, please. We all think differently, but this just gives you the same idea. If you think differently, how I interpret is the same, but how I remember it. Okay? Okay, so now we have that, no problem. Okay? And now, example of a chart. And all the chart is just telling you what's going on. Graphically, I can see what's going on. Same, the year, what happened last year. It says, oh, here's across rate of pounds, okay? And against the Swiss francs. And this is the value of the pounds and the Swiss francs. So you have both of them, right? And here's that, and we're going against the dollar here. Okay, so here's the two currencies moving the same direction. Here's the other one. When I'm looking at the cross rate, very similar. Kind of in the middle here. Okay, the graph kind of throws you off a little. It's about the same. So, are we okay? See the same movement. And then here's example of how forces affect across. Look at the different sections. Different value, annual changes, and again the cross rate, a pound in I want to say Swiss francs. Okay, SF. I was going to say San Francisco. Sorry. All right. We good? Okay, so we finished that. Now, let's look at the expected exchange rate movements. Remember, this is a summarization. You have it. Look at my sheet. What did I forget? Oh, I didn't get this. I did get this. Institutional speculation based on expected appreciation. I'm thinking it's going forward. Financial institutions believe that the currency is valued lower than it should be in the foreign exchange market. Then they may invest in that currency before it appreciates. Remember, I'm a business person. What market's open? So look at my currency. Look what's going on. Remember, because I could bring currency in and back from different countries. When do I bring them back? When do I pull it back here and exchange it into mine? I want to exchange it when I have the same thing. Nutshell. I have a lot of people, friends I know that are in the small business, copper. So I'm a plumber. I'm just making this up, just so you can understand it. You need something tangible, so you don't think, "Oh, this is so hard." Look at copper. Copper is a commodity. Here's a product. I got some of copper. I take copper out. I put new copper in. What's the price of copper? Fine. Copper is stable, so I buy a lot of copper, figuring something's going to happen. Let's say there's going to be a strike or whatever in the copper field, so no price is going up. So I got all this copper. I can keep it for myself, keep my costs, my expenses lower, my inventory lower, but still charge the higher prices, or raise my price a little bit because, hey, copper prices went up, but so I'm making more profit margin. Or I'm a regular plumber. I buy the copper. They take off the old copper. They don't want to get rid of the copper. I just throw it away. I scrap it. I cut all the good pieces. When do I sell it? I'm looking to see when the copper prices are up, or anticipating the copper prices are up. Unless I need the money, in the spot market. So I'll hang on to that. Once I see it going, I see the movement. Do I sell now, or how long do I go? Do I hit the plateau, and I'm looking at when it starts dropping? Maybe that's when I go in there and cash in my copper. So this is what the expected exchange rate. Anticipation. Okay? Institutional speculation based on the expected depreciation. Same thing. I have all this copper and I see the copper going down. Either I sell it to somebody else, get rid of the inventory, or do I wait it out? Same thing with housing or anything else. But now I'm only looking at my currency. So financial institutions believe that the currency is valued higher. It should be in the foreign exchange market. I know it's already overrated, overvalued for whatever speculators did something. Okay, so they may borrow funds in that currency because it's low, convert it into the local currency now before the currency's value declines to its proper level. Okay, now speculation by individuals. Individuals can speculate in international currencies, buying for. Usually, you could speculate when you're buying. The banks got like the robo the calls. That's where speculators mess up some of the pricing. That messes up the whole market because the computer is just looking. They're looking at certain factors. The prices are going up. A lot of people are buying. There must be something going on. We don't know what, but we don't want to fall behind, so we're just going to buy it at this thing before buy it now. Hopefully before it goes too high. So we have it, but if it's a speculator and the market corrects itself and I don't get rid of it in time because for whatever reason I'm stuck with it, just hold off with it. Okay. Now, when we talk about the carry trade, the definition, real quickly, investors attempt to capitalize on the differential in interest rates between two countries. Impact of appreciation in the investment currency, exchange rate movements over a shorter period, increased trade value can have a major influence on it. Okay, and the impact of appreciation. I remember, like I mentioned before, I see too much movements. I'm thinking no different when I'm buying and selling stock. I see a lot of people are buying shares in certain things. Oh, there must be something going on. Maybe they got a new contract, so I want to get into the bandwagon when I see the movement going up, or I see it's going down. What's going on? Something's going on. So there's some risk in that, but I'm anticipating. Increase in volume or decrease in volume is a signal, and a lot of banks, because they have so much money invest, despite a little time frame. Remember, time could affect my bottom line. Okay. Now, risk of carry trade is exchange rates may move in the opposite direction to what the investor expected. Okay. So that took care of this. We're pretty good on here. We're done. Let me just close all these off. The only thing we have left is the summary. I'm not going to go in. I'm going to go real quickly with the summary. I haven't done the summary before, but I think what I would want to do with the summary here is that I'm just closing this off while I'm talking, just like I live in the classroom. I'm not there working. All right, so you have me on here. Remove this over. Okay, let's look at the summary. Exchange rate movement. What did we learn here? Remember, I'm just giving you a quick overview. Measured by the percentage change in their values over a specific period. You always look at a certain period, such as a month or a year. Could be even weekly, daily. Depends on the instability or the validity of the movement of the currency. Are we okay? So let's see. What do we have? The equilibrium exchange rate, volatility of the movement. All right, so equilibrium exchange rate. English is second language for me, so some words I just can't. I know it, right? I don't twist the tongue. Those who speak other languages, you have no problem. If you speak Spanish, you speak German, I speak Polish. My basic language is Polish. You learn to twist your tongue. Since I don't speak the language as often anymore, I understand it, but the word's not coming out. So bear with me. We're human. I'm alive. All right. Between two currencies on the demand and the supply condition, changes in demand of the currency or the supply of the currency for sale will affect the equilibrium exchange rate. Just write them down. This is what we're learning. This is what you should have learned. Key economic factors, that one's easy, can influence exchange rate movement. You know that was going on through their effects on demand and supply conditions. And some of the key ones are relative inflation rates, interest rates, not the real inflation, just relative what's there that you're looking at it. You want to get the real, you subtract. Interest rates, income levels, and the government controls. These factors lead to what? Change in international, that's what we learned, international trade or financial flow of currency. International trade is going, they need more money or currencies for that financial institution or the investment broker or whatever, so they could transfer money back and forth. Affect the demand for the currency. We're going to look at currency as a commodity, as a good, or a supply of currency for sale, and thus their equilibrium exchange rate. Okay, so it could change that. Distinct international trade and financial flows between every pair of countries. Flows dictate the unique supply and demand commission. You know, I only got me and another country two. Now I'm operating three, or maybe operating 10, or maybe operating Citibank and Chase. They operate in all the countries, so you got a different relationship between that. They have to monitor all of that. But once going on, they can move it over here or bring it from a different currency. But they've got that. You know, that's their whole expertise. You could do that also. You don't have to worry about the whole world. I mean, you have to know what's going on. This is a big global economic crash, a big war that affects everyone. No problem. But if I'm looking at my, if I was doing business with Greece, do I do business with Greece? You know, I pull back and everything else, on everything else, no currency. Now they got the bailout. Okay, I'll start doing business. How long is the bailout good? Will they keep the austerity, or are they going to come back and say, I blew it again, I can't do it, and they're going to kick them out of Euro? So I may anticipate, you know, I already got some currencies. I could anticipate that there's going to be growth, but when it comes closer to, and I'm looking at the economic condition degree, they're not changing. I scale down doing business there, or scale down my inventory for that country, so I'm not stuck with more than I need, you know, my product, for lack of better words. Okay, direction between a pair of countries, we have that. Movement in the exchange rate is between two non-dollar currencies can be inferred from the movement in each currency against the dollar. What does that mean? Look at the movement exchange rate. This is a summarization which you should have picked up what's going on here. Strategically, what are they actually doing? All that verbiage I read on that, you know, maybe a page or 2 page, and examples and problem. I understand that. Here it is. I have it in 1-2 sentences. The author has in 1 or 2 sentences. Financial institutions attempt to benefit from expected appreciation of currency by purchasing that currency. Okay, now expected depreciation of currency by borrowing that currency and exchanging it for the home currency. Remember, there's my benefits. I'm purchasing it. Expected the depreciation. This is appreciation. Now, let me do it this way, because most people are visual. I'll take care of this now, so it makes it easier. So you can see what we're talking. This is appreciation. It goes up, and this one's depreciation. Remember, no different if you're doing math. What are you doing math here? I mean, if you're taking any kind of math, a word problem. Look at this as a word problem. And what do I have? I've got all these ands, buts, everything else here. I just need what's going on. Out of the whole sentence, I pull out the key factors for me to set up my equation. So appreciation goes up, depreciation goes down by borrowing that currency and exchanging it. So going down and borrowing it, and later on exchanging it for the home currency, right? Because depreciation, I could get more currency with my own. Remember, the dollar is strong and the pound is weak. So for that dollar, I may get more pounds or euros, and I bring it into mine, and then hopefully something happens so I could have that currency to, you know, against the dollar to either fund or do something else, hoping that currency will go up. Okay, or utilize. I have more of that currency in that market or the subsidiary that I'm working. Okay, so that's my summary. That's our things. I hope I made it within an hour, and not more than an hour and a half. I'm trying to speak a little bit slower, you know, because there's a lot of information. But remember, you can always stop me at any time and then open up. So what I do: go, stop, write down, see what I have, go, stop, right? Just like you would in the classroom, and this should be a summarization, but you already understand it. Concept math do you very little unless you read the material and have a first exposure. We talked about it, lectures or a discussion group, and this is just now I understand what's going on, because in my mind I could visualize that. And if there's a lot for you now, do not worry. The more you're exposed to these terminology, I'm trying to get you the terms and concepts, so when you're talking to people, you understand what they're saying, you understand what the movement, downward pressure, upward pressure. If you don't understand that, you in your mind could read the words and see my arrows, look at the bold areas, and you remember. So you know, if you're going to go into finance, international, any kind of national, I would keep most of my international books. They're good references. This one here is very current. I think it's the newest edition. The author did an excellent job. Again, my name is Dr. George Mochocki. This is International Finance. We're covering Chapter 4, Exchange Rate Determinations. How do you determine the exchange rates? And what you're going to find out is all through research, looking at historical data, looking what's going on, and trying to anticipate. There's software that banks utilize. I'm just in a small business or medium. I can just read the Wall Street Journal or look at some of the Federal Reserve sites, and put something on your smartphone or something else that gives you some uh, notification. Hey, so many shares are sold, or something's going on with the currency. It's exceeding, and so I got to start looking at it. I don't have to act right away, but I have to be current. So current means I'm always monitoring, I'm always reviewing, I'm checking it. Not some people do it, or let the system technology check it for every day and just give me a warning. All right. Again, so I'll see you in Chapter 5 is coming up soon. Have a nice day.